Okay, well, thanks a lot, everyone, for joining us today. We are very happy to have two great talks lined up to you from Rustam Jamilov and Monika Piazzesi. Quick reminder of the ground rules. Everyone's cameras and mics will be off. During the Q&A session, the final 10 minutes, if you'd like to ask a question live, you can raise your hand and we will give you the opportunity to unmute yourself, but we won't unmute your camera without you asking us. So if you have questions during the chat, please use the Q&A function and reserve the chat function in case there's technical or other difficulties. So without further ado, Rustam, you have 10 minutes.
Okay. Thank you very much. Great pleasure for me to present to you today my paper, a macroeconomic model with heterogeneous banks. The theme of this work is really can be summarized in a very simple way: micro-consistent macro banking. It's really trying to understand how banking and finance affect the macroeconomy in a way that is consistent with state-of-the-art empirical microevidence. To that end, in this particular paper, I will be trying to understand positive, normative, and policy implications of heterogeneity in the banking sector. And in order to tackle this problem, I will develop a quantitative microfinancial framework with 4 carefully and empirically validated ingredients. So the 4 channels that I will be focusing on in this paper are the distribution of bank size, variation of efficiency and intermediation across that size distribution, endogenous competition on the asset side of bank balance sheets, and financial stability. Although there are a lot of moving parts in this framework, the single unifying main result is that financial efficiency, competition, and stability channels are incompatible with each other. So it's impossible to simultaneously improve financial efficiency, competition, and stability in the modern banking system. It's a trilemma. So in order to arrive at this result, I will first show to you some motivating empirical facts that I used to build the framework. The first fact is very important. It's the fact that bank size heterogeneity is there in the data, and we need to have a good, realistic quantitative framework that can be consistent with dispersion and concentration and bank size. Moreover, the degree of concentration is increasing over time, not just in the US, but also for the rest of the world. So having size heterogeneity in quantitative macro models is crucial because banks of different size react very drastically differently to in various circumstances to all kinds of aggregate disturbances. So it's important to have that ingredient first. Second, it turns out that one of the channels that runs through size heterogeneity of banks in the cross-section is the endogenous competition channel. So banks have different levels of markups on the asset side of the balance sheet, and markups increase with size. So we need to have a model which will be able to speak about variable lending markups that potentially increase with relative size. Third, there is a large empirical literature in banking on the economies of scale in intermediation. One of the many ways that can be manifested is here in the graph, it's a positive correlation between total assets growth and leverage growth of intermediaries. But there is a big literature that has found that marginal costs, marginal interest or non-interest expenses decrease as the size of the intermediary goes up. And finally, the fourth ingredient is the financial stability channel. Bank default is a very big issue, of course. Social costs of default are potentially large, but in the cross-section, I find that, not surprisingly, exit risk decreases with size. So as the size of the intermediary falls, the probability of exit in the next quarter increases. So having seen these 4 empirical facts, now I'm ready to build a quantitative framework that will help us to make sense of the data. The first ingredient that I will need is uninsurable and persistent idiosyncratic bank return risk. That's the classic Bewley-Huggett-Ayagari-Mrohoglu problem, now adapted for the case of financial intermediaries. The second important ingredient will be scale invariance, meaning all the choices that banks will be making in the model, such as assets, deposits, or lending markups, will depend on the size of the bank. Scale variance together with persistence of idiosyncratic shocks will give me a stationary distribution of bank size in equilibrium. That will be consistent with the first fact that I showed you before. Then, on top of this machinery, I introduce non-CES demand for bank credit in the spirit of Kimball. So the Kimball aggregator will make the elasticity of credit demand dependent upon the relative size of the intermediary in a way that will be again consistent with the data. Bigger banks will be choosing to have higher markups. And fourth and final, endogenous intermediary default can be introduced as well, such that small intermediaries will default more often, but the social cost of default increases with the size of the bank. So now we have a model with 4 ingredients that will be consistent with the 4 empirical facts of the data. And in order to show you the main result, I will walk you through this picture for the remainder of the presentation. So here is how the stationary distribution of bank net worth looks in the model. It's dispersed, it's concentrated, meaning that a small fraction of intermediaries control a large proportion of the banking industry. To achieve this object, all we need is scale variance and idiosyncratic shocks. So on top of size heterogeneity, which is consistent with fact 1, now we introduce the Kimball aggregator. That gives us now on the right vertical axis markups that increase with bank size. So higher levels of net worth will be correlated with higher markups. So again, markups are endogenous and bigger banks choose to have higher markups. And that's what I call the endogenous competition channel. Then we realize that bigger banks will have lower marginal costs, represented here by this pink diamond scatter plot. Marginal cost will be lower for larger banks because they have a better history of idiosyncratic shocks. They are more lucky, they face lower interest rate on deposits in general equilibrium, and they default less often. All these 3 ingredients feed into the marginal cost object, which is a complex nonlinear object, but it happens to decline with net worth for the reasons I just explained. And finally, the financial stability channel is the insolvency risk, which decreases with bank size. So here, the black squares represent insolvency risk, and as the size of the intermediary falls, the probability of default goes up. So now we have all we need in order to arrive at the main result, the banking policy trilemma. It is apparent that the same banks that are financially stable and efficient also have greater market power. So banks which are in the right tail of the size distribution have lower marginal costs, they're more efficient and intermediating doing their banking activities. They default far less often, but they also have a higher degree of market power on the asset side. So as a generalization of this situation, we claim that no single aggregate shock or policy intervention that in any way reallocates credit in the banking sector will be able to simultaneously improve competition, stability, and efficiency. For instance, any aggregate disturbance that shifts in equilibrium the allocation of credit towards the right tail will decrease financial risk, so financial stability will improve, efficiency will improve, which will generate relative welfare gains, but those 2 channels will be counteracted with the relative welfare losses from increased credit market power. And the same logic applies for any aggregate shock that redistributes or reallocates credit towards the smaller intermediaries. So this is a very simple this trilemma is a very simple way to synthesize and organize our thoughts for a whole myriad of classic and modern issues in macro banking. And in the paper, I look at the following exercises. So the trilemma can be used to guide the design of optimal constraint efficient bank taxation, the design of size dependent capital requirements, deposit insurance schemes. The too big to fail externality actually can be well understood through the trilateral trade-off that I discussed on the previous slide. the rise of banking concentration. So the model has clear predictions of what to expect in terms of stability, welfare, and efficiency going forward, given this ongoing trend in banking concentration. Emergence of fintech intermediated credit. When I introduce endogenous entry and simulate the rise of fintech firms, we can speak about the welfare implications of fintech firms. Targeted bank-specific policies, because we have the full distribution of bank size, we can design policies which target a particular decile of the distribution, but not anyone else. And finally, there are implications for asset pricing. So thank you very much. I hope you read and enjoy the paper.
Thank you very much. 2 seconds over time, so perfect. Very well done, very interesting. And so for people that would like to chat more, we'll have the informal session afterwards that you can come and have some chat. Looking forward to that. So Monika, you have 40 minutes. Take it away.
Thank you very much for having me. This is joint work with Melina Papuzzi at the ECB and Maarten Schneider. So in the current low interest rate environment, the main tool for monetary policy has been unconventional monetary policy. So these are asset purchases. Central banks have been buying government bonds, mortgage-backed securities, and most recently, they've been buying corporate bonds. And that raises the question, which corporate bonds should central banks buy? The conventional view on this has been that monetary policy should aim for market neutrality. That avoids relative price distortions from asset purchases. And in practice, it's been implemented by buying bonds proportional to bonds outstanding. In this paper, we ask, what are market neutral purchases of corporate bonds within the model? How do you think about those? And what would be optimal purchases in a world where you have both financial frictions and climate externalities? We first look at the data. We measure the carbon footprint of ECB purchases and look at what corporate bonds the ECB has been buying so far. So we measure the ECB's sectoral portfolio with data on individual bonds. The majority of these individual bonds is issued by special purpose entities. And so that actually involves some work to hand match these corporate bonds that are issued by these financial companies to the non-financial sectors that actually issue them. That gives you the portfolio. And then we compare the ECB sectoral portfolio with 3 alternative measures of the market portfolio. These are different measures of concepts of capital in the various sectors. And then we find that the ECB portfolio looks like the sector shares of emissions. It doesn't look like the sector shares of capital or the market portfolio. And so that raises the question, why does the ECB overweigh dirty sectors in its portfolio? Why is this happening? And the reason is that the ECB purchases proportional to bonds outstanding. And because dirty sectors issue more bonds, they have a lower market share, these sectors. That leads to a portfolio that looks overwhelmingly dirty. And so if you then look at eligibility requirements that exists for bonds to make it into the ECB portfolio, they actually don't change this basic pattern. So the basic pattern is that dirty sectors issue more bonds and the ECB buys them. We then want to think about what is within a model, how do you relate price distortions to portfolio and what central banks are buying? So here we specify multi-sector growth model with climate externalities and financial frictions, in which sectors differ by how risky they are and the emission intensity. And then here in this world, asset purchases work through risk premia. Their effects differ by sector. In the model, a market neutral policy leaves the sector's relative costs of capital unchanged. And so in that sense, you don't distort relative prices. And that implies that the market portfolio, the sectoral capital shares, those are unchanged. If you look at the purchases that are market neutral, they won't look like the market portfolio. So they will not be proportional to capital shares, except in some very special cases. In particular, market neutral purchases will underweigh risky sectors to offset general equilibrium effects from having more safe government debt that is associated with these policies. So typically, these purchases are financed with more safe government debt, and that has general equilibrium effects, especially for the risky sectors. And so to stay market neutral, the purchases have to underweigh these risky sectors. What is optimal policy in this world? Optimal policy designs a carbon tax and an asset purchase program so that optimal purchases, they address financial frictions. They don't necessarily target the climate externality. They will only be correlated with the climate externality as long as that shows up as stronger financial frictions. Optimal policy will not be market neutral except in special cases. And in particular, this optimal policy will lower risky sectors' cost of capital the most. But what happens in a world where you don't have a carbon tax, like the world we live in? So monetary policy, if there is no carbon tax, will find it to be beneficial to overweigh green firms. So you would put a higher portfolio weight in your purchases on green firms. So our paper relates to different literatures. First, there is a large literature that documents the price impact of unconventional monetary policy, just empirically in the data, how strong are these effects? There are papers that study the economic mechanisms that give explain why there might be real effects from unconventional monetary policy. The model builds on integrated assessment models in which the environment or the climate has an effect on TFP, and you'll see that also in our model. There's also an empirical asset pricing literature that documents that firms that have high emissions have higher cost of capital. So there are pollution premia in the data. And that is part of a growing, in fact, exploding literature on climate finance. So let me first show you the empirical work that we do in the paper. So at the individual firm level, we merge ECB securities holding statistics on purchases of individual bonds by the ECB. We merge that with the ECB centralized security database that contains bonds outstanding for all firms in Europe. And we have scope 1, 2, and 3 emissions from Urgentem for individual firms. So we merge these 3 databases so that we have how many bonds does the ECB have of individual firms, what are the bonds outstanding, and how high are the emissions of these companies. Then we have sector level data on scope 1 emissions from Eurostat air emission accounts. We have value added wages and output from Eurostat by sector, and output in total book assets, together with market value for public firms from Orbis. An important feature of this data situation is that special purpose entities issues most of the bonds in Europe. So for example, the ECB buys bonds from Royal Dutch Shell, which is an oil manufacturer. And the bonds that are issued by Royal Dutch Shell are actually issued by Shell International Finance, a limited liability corporation, which is a company that belongs to the finance sector. And so if you look at the ECB portfolio without doing any work, you would conclude that the ECB mostly holds finance companies. We research these entities and attribute the bonds to their right sector. So in this case, we attribute them to oil manufacturing. And that reduces the ECB holdings of the finance sector from 56% to just 11%. And so from now on, I will just show you holdings of non-financial firms by the ECB. Then we want to measure market shares by sector. So we want to know what is the share of sector capital, so capital in sector N in the total capital stock in the economy. The ideal measure here would be the market value just of equity and debt, so the total value of the firm. Here, I'm going to show you the basic results with alternative measures. The first is our benchmark measure that looks at capital income. So if you look at the first order conditions of firms, they equate the marginal product of capital with the cost of capital. And if these cost of capital are identical across firms and depreciation rates are the same across sector, then I can look at capital income by sector, and that will imply how much capital there is in the sector. And so we measure this capital income as value added minus wages in Eurostat. So this is one measure, but then we look at alternatives. The second alternative is to look at output from Eurostat multiplied by book assets to revenues from Orbis. So this gives you a measure of total book assets from Orbis. Ideally, you would want market values, but we only have that for public firms. But that's our third measure: is you take all the public firms in the sector and look at their market value. And so let me show you the results when you do that. So here is on the vertical axis, you have various sectors in the European economy: agriculture, automobile. Then we take the large manufacturing sector and split it up by dirty manufacturing, which contains all the subsectors that have high emissions, like oil and coke, chemicals, basic metals and non-metallic minerals, and other manufacturing. Then utilities, transport, and services. And so with these red bars that are measured on the horizontal axis, these are market shares of the various sectors in Europe. So as a fraction of 100%, you see how large these sectors are. And so what you see is that agriculture is small, the automobile sector is small, the largest sector is services. That's the dominant sector in the European economy by market share. Let's compare that with holdings by the ECB. So these are the blue bars. Again, these are the portfolio weights on the various sectors. And so what you see is that the ECB doesn't hold any agricultural bonds. It holds a small amount of automobile bonds in its portfolio, and then larger share on dirty manufacturing and utilities, and it underweights services. So if you compare that with the emissions by sector, so these are the sectoral shares of emissions. Those are the gray shaded areas. These are scope 1 emissions, so direct emissions of carbon. So you see you compare the ECB holdings in blue with these gray shaded areas. And so what you see is that the ECB is overweighing dirty sectors like dirty manufacturing and utilities. And it's underweighing services, which is a sector that is relatively clean. It has the largest market share, but the ECB is underweighing that sector in its portfolio. So that's our main finding. The ECB portfolio looks a lot like emission shares. It does not look like market shares in the economy. You wonder, maybe we measured market shares in a funky way by looking at capital income. Here is measuring market shares using total assets from Orbis. So the red bars are now total assets, and you get the same picture. So services is the biggest sector in the economy, and the ECB is underweighing that sector while it's overweighing dirty sectors with high emissions like dirty manufacturing and utilities. And this, you get the same picture using our third measure. I didn't show this, it just looks the same. So the main empirical finding in our paper is that the ECB portfolio looks like the sector shares of emissions. It does not look like the market portfolio. And so then you wonder, why is that happening? Why is the ECB overweighing dirty sectors? So let's look at that. It's because the ECB buys proportional to bonds outstanding. So here we have, again, the market shares of the various sectors in red. You have the darker red bars are now the amount of bonds outstanding of these various sectors. And so you look at that and you compare it to the blue bars, which is ECB Holdings. And now you see that what the ECB is doing is basically buying bonds proportional to the amount of bonds outstanding. The purple bars are what are eligible bonds in the various sectors. And you see that the eligible bonds, they look a lot like the bonds outstanding. So eligibility doesn't really change this pattern. It's really only the fact that the ECB buys proportional to bonds outstanding, and then that ends up with a portfolio that looks mostly dirty. So again, the ECB portfolio looks like sector shares of emissions. It does not look like the market portfolio of the European economy. And so why is that happening? It's because the ECB buys proportionally to bonds outstanding. And eligibility criteria don't change this basic finding. If you account for indirect emissions, so the graphs that I showed you were for direct emissions of greenhouse gases. If you account for indirect emissions that have to do with how consumers of products that these companies produce, how do they cause emissions? If you count all these in, the picture looks worse. The ECB portfolio even looks dirtier than it looked in the graph that I showed you. And we also show that you may think, oh, the ECB is just one of many players in corporate bond markets, but actually in recent years, the ECB has become a large investor in corporate bond markets. It buys a substantial fraction of new bond issuance. So how do you make sense of these purchases within a model? What are market neutral purchases and optimal purchases of corporate bonds? So let's look at a growth model with climate externalities and financial friction. So here we have a representative agent with preferences over a final consumption good, which inelastically supplies 1 unit of labor. So standard preferences, inelastic labor supply. And the final good that this agent consumes is made out of n intermediary goods. They are produced using a Cobb-Douglas production function. And then, so put together out of these intermediary goods. And then sector-specific, there are sector-specific climate externalities in production. So there's temperature, eta, and temperature goes up with new emissions. So you see on the bottom right here, temperature, new temperature is temperature last period plus the new emissions. Those raise temperature. And eta here is the emission intensity of sector N, and YTN is the output of sector N. So various sectors have different emission intensities and they contribute to temperature. And temperature here will affect, has negative consequences for TFP. So TFP is Z, and Z depends on eta. And so this is the impact of temperature on TFP. So emissions raise temperature, and then temperature affects TFP. The second feature of this model are financial frictions. So there are two technologies for households to hold capital of firms, to hold capital of firms. You can hold capital either through a public technology or a private technology. Both technologies come with some balance sheet costs. So there are some cost functions that tell you how large these balance sheet costs are. There's one for the public technology, H wiggle, and there's one for the private technology, H. These are resource costs in terms of final goods. They're increasing quasi-convex and homogeneous of degree 1. These are private costs. So the H, the private costs, also depend on holdings of government debt. So it may be cheaper to hold capital if you have a lot of safe government debt, DT. The public holdings of capital are financed with debt issuance. So the total amount of capital holdings through this public technology are equal to total debt. And these costs may depend on calendar time. So for example, in times of financial distress, these cost functions may be larger. What is the interpretation of these cost functions, these balance sheet costs? Well, they capture risk. Risky investments are costly. Some don't pan out. In that case, resources are gone. And so you have these resource costs. And holding more capital is riskier. It's associated with more costs. That's why they're increasing. And the risks also depend on holdings of safe government debt, because that may lower the risks involved of holding capital. So who does the holding? So there are private intermediaries that invest in capital through the private technology, or they invest in government bonds. They're competitive firms. They're owned by households. They maximize shareholder value. So they maximize the pricing kernel, which is the stochastic discount factor of the households, times the payoff of their investments, which is returns on capital plus interest on government debt. But they have these balance sheet costs, H, when they do these holdings, and then they invest in these assets. The first order conditions of this problem equate the return on the various investments multiplied by the stochastic discount factor of households equal to 1 plus, and then there's a premium over the short rate for holding capital in sector N. And that's the partial derivative, essentially, of this holding cost function with respect to capital in sector N. You also have a first order condition for holdings of government debt, and that has the partial derivative with respect to debt. So these are the marginal balance sheet costs for holding government debt, which may be negative. So you may have a convenience yield here for holding government bonds. So without any of these balance sheet costs, you get standard Euler equations where the pricing kernel is just simply the stochastic discount factor of households. But these holding costs, they introduce return premia. Firms, you have intermediate good firms, they issue claims to capital income, they pay a return Rn, they hire labor at a wage W, they sell the goods at a price P, that depends on the sector in competitive markets, they pay a carbon tax, tau, per units of their emissions, and then they maximize profits. So these are competitive firms, they maximize profits. Final good firms, they buy intermediate goods at the price PN, and then they sell the final good at price 1. And so you have first order conditions of these firms, and in particular, the marginal product of capital net of the carbon tax is equal to the cost of capital. And that cost of capital, because intermediaries are holding these capital claims to capital, that will contain a risk premium. So what does the equilibrium without a carbon tax look like? So you have, let's look at asset position. So here credit flows from households to competitive intermediaries to competitive firms. And then the government has a policy where it buys assets, these K-wiggles, and it finances these asset holdings with debt. So the government budget constraint has gains from past asset holdings, then it issues debt, then it raises these carbon taxes, and it has to pay interest on its past debt. It conducts asset purchases, but then it faces these balance sheet costs, and then does a lump sum rebates or taxes. And then agents optimize and markets clear. So let's look at what happens in equilibrium. So let's first look at the frictionless benchmark. Suppose there are no financial frictions, then how does the sectoral allocation of capital happen? Well, in that case, the equilibrium will solve for a market portfolio that just equates marginal products across different sectors. And the market shares, so the kappa n's, which is the amount of capital in sector N, that will just reflect technology and preferences. So the alpha, the Cobb-Douglas parameter alpha, and the gamma. In this world, Modigliani, Miller, and Ricardian equivalence holds. So asset purchases are irrelevant for investment and the climate because if the government buys any assets, the private sector just undoes this policy, and we end up with the same kappa that solves this equation. So here, government purchases don't matter. If you listen to some commentators, they will say, well, financial frictions don't matter. We live in this world without financial frictions. But it's really important that central bank purchases are designed to be market neutral. This argument doesn't really hang together, because in a frictionless world, actually the private sector undoes anything that the government does. So it's not really important for central banks to be market neutral, because what they're doing doesn't matter in a world with Modigliani-Miller. So just as a commentary on what you see on the blogosphere. So here, let's look at the equilibrium without a carbon tax in the presence of financial frictions. So here, the sectoral allocation of capital will solve this equation. So now, as before, marginal products of capital will be equal to the cost of capital. But now you have these marginal holding costs of intermediaries of holding capital. So here, the market portfolio equates marginal products net of holding costs. And so here, what happens in this world with financial frictions is that sectors with higher marginal holding costs have higher premia over the short rate. So you see here, this HN, this partial derivative, is going to raise their cost of capital over the short rates that is implied by the household stochastic discount factor. So they will invest less. Their kappa N in this denominator will be lower. And then government policy, by choosing asset purchases financed by debt, they will affect the cost of capital of different sectors through these premia on the right. So the premium, the government policy affects these premia, these marginal holding costs. So let me briefly discuss the assumptions that we made in this world, in this model. So what's the role of the central bank here? This is a real model. It doesn't have price nominal, doesn't have sticky prices, for example. So here we focus on risk premia and investment, not on price stability. But with flexible prices, you get similar effects in the nominal model. And we have a previous paper that works just like that. It has flexible prices. So in other words, what we're doing here is we think of this model as taking a medium run perspective. So we've looked at a decade of data on large central bank balance sheets, and we want to know how that matters for the sectoral allocation of capital and risk premia in this world. There are holding costs of capital for private banks and also for the government and the central bank. This captures a familiar theme from the literature. So here, QE stimulates the economy when the government can commit to repay more cheaply than the private sector. And so the new element here is that multiple sectors have different severity of frictions, and they're described by these holding costs, H, and those are reflected in firm level risk premia. And so H can be identified from effects of purchase programs on sectors, cost of capital. That would just extend the work on the price impact for government bonds by looking at what happens in these various sectors to these premia. So in this model, climate externalities and financial frictions interact. And so we expect these parameters of these balance sheet costs, H, to vary with the emission intensity in the cross section. So you have the emission intensities, these epsilon that affect temperature. You would expect these parameters to co-vary with H. And in fact, there's empirical evidence that I mentioned before that brown firms pay higher premia. So these two things are indeed correlated. So what happens if the central bank directs capital towards green sectors? So let's look at this equation again, which has the demand of capital on the left-hand side. Basically, you see here that the kappa N is inversely related to the cost of capital. That's the demand for capital. On the right-hand side, what you see is that increases of holdings of capital are positively associated with the cost of capital. So basically, we're looking at a demand and supply for capital. Because these balance sheet costs are homogeneous of degree 1, I can actually replace these capital holdings and bond holdings with shares and rewrite these marginal holding costs using the government portfolio kappa wiggle and the government debt to capital ratio delta. That allows me to put everything into a nice demand and supply graph where on the horizontal axis you have the capital share and on the vertical axis you have the cost of capital for the sector. And so suppose now the government increases the weight in its purchases on sector N. and it lowers some other weights. So it keeps its total amount of debt unchanged. What that does in this diagram, where you have the firm's demand for capital and the supply, that shifts out the supply curve. And so that will lower the cost of capital for sector N, and it will increase its capital share. So here in this world, the government policy does have an effect on the cost of capital and the capital share. Our leading example for these cost functions is quadratic. In the quadratic case, so you see here, we have a cost function that is quadratic in capital holdings and holdings of government debt D. The coefficients here are the riskiness of the typical firm in sector N, with this parameter sigma squared, which may be correlated with sector N emission intensities. And so this quadratic setup captures the benefits of diversification because you want to put a little bit in all sectors. That lowers costs. It's just like in the classic mean variance framework. This is what this captures. And government debt here is maybe safer because the sigma squared D, this parameter is smaller, will be smaller than many of the sector's riskiness. So government debt is safer. Here, the premium on sector N is just taking the derivative with respect to capital in sector N. And you get this, first of all, this derivative, the partial derivative, this is the marginal cost for holding capital in the sector. If you focus on the blue things, these are the exposures of the private intermediaries to sector N risk. So it shows you that the risk premium for sector N will be higher if the exposure of private intermediaries will be larger to that sector. If you think about safe assets that have no risk, so set these sigma n's to 0, then this model gives you a negative premium or a convenience yield on safe assets. And so then the purchase program will reduce exposures because you're changing these kappa wiggles and these deltas. So let me then say, what is market neutrality? It leaves relative returns unchanged. You start from a laissez-faire equilibrium with no government debt, and then look at a comparative static to an equilibrium with government with positive amounts of debt. And then market neutrality will imply, because it has to leave relative returns across sectors unchanged, it implies that the market portfolio will be unchanged. And so the question is, what is the market portfolio, the government portfolio kappa wiggle that keeps the market portfolio kappa unchanged? For example, if H is separable in capital holdings and government debt, then a neutral purchase program would just purchase relative to the capital shares in the economy. That would be a very special financial system in which government debt that is issued to finance these purchases doesn't affect premium. But more generally, market neutral purchases will not look like the market portfolio. In fact, the market neutral purchase, any purchase will lower risk premium, especially of risky sectors, because you're financing these with government debt, and that will reduce mostly risk premium of in these risky sectors. And then neutral purchases underweigh risky sectors to offset this effect. So basically, imagine that you conduct a purchase, you finance it with debt, you're lowering mostly the premium of the risky sectors. So to stay neutral, you have to underweigh these risky sectors. How would this look like with quadratic costs? So the premium, the return premium on sector N looks like this with my leading quadratic cost example. The second term is the same for all sectors N, because we're summing here over the sectors. So that's the same for all sectors. So if you look at relative premia across sectors, we're looking at the first term. So let's look at that. So it's the difference between the premium on sector N versus the first sector, let's say. So these relative premia reflect the relative exposures of private intermediary to risks. And so how can you be market neutral in this world? You have to leave relative premia and these kappas, the market shares, the same. So they have to be independent of delta. So how do you do that? You underweigh risky sectors. The government debt will lower premia of risky sectors more by choosing an investment holdings of capital that are constant relative to sigma squared of the sector. So basically the market neutral portfolio solves this equation. It's a constant over the risk in the sector. And that is in mean variance speak is this looks like the minimum cost portfolio that the government picks. So market neutral in this world with quadratic cost means holding the minimum cost portfolio. So this is the portfolio that just minimizes holding costs. So note that this minimum cost portfolio has nothing to do with the market portfolio. So you're just holding capital relative to the riskiness of the sector, not relative to the market portfolio, how much capital there is in the various sectors. What is optimal policy? So here, optimal policy would have a social planner that chooses a carbon tax and an asset purchase program. And so the principle of targeting applies here from public finance, which is you pick the carbon tax to fix the climate externality. The purchase program addresses the financial frictions. It doesn't have to do necessarily with the climate externality, but to the extent that those two are correlated, the financial frictions with the climate externality, for which we have empirical evidence, then it will have to do with the climate. So the optimal government portfolio solves the following equation. It will basically equate marginal holding costs by the private sector of holding sector and capital with the marginal government holding costs of holding this capital, plus the externality that the government has on marginal private holding costs, because by issuing debt, it will affect marginal private holding costs. And so what the government does optimally, it equates these marginal private holding costs with the marginal government holding costs plus this externality. So the government takes the externality into account that it has on intermediaries who hold capital. So the optimal policy depends on how high these government holding costs are. If the government marginal costs are the same across sectors, so if these H wiggle N, these partial derivatives of the public holding cost function are the same across sectors, what the government would do is just equate premia across sectors. That would lower premia for risky sectors the most. So optimal policy here is not going to be neutral, because remember, neutral policy underweighs risky sectors. Here we're shooting for a policy that will reduce the return premium for the risky sectors the most. So optimal policy is not going to be neutral. For it to be neutral, you really need a knife edge condition. So in general, it will not be neutral. So let me summarize what we do in this paper. So first we have an empirical result that says what the ECB has been doing so far in the past. It has assembled a portfolio that looks like the sector shares of emissions. It does not look like the market portfolio. But if you look at market neutral purchases within a model, actually this buying in proportion doesn't make sense, because that is not even market neutral. So market neutrality in the model doesn't say you should be buying assets in proportion to capital outstanding, because market neutral, by doing these asset purchases, you're issuing debt, and that will benefit risky sectors the most. And so to be market neutral, you would actually have to underweigh risky sectors. So in our leading example with quadratic costs, when purchases are financed with more government debt, you lower the cost of capital of risky sectors the most. You would have to downweigh these risky sectors to be market neutral. And we know from the data that dirty sectors are risky. There's evidence of a pollution premium on risky assets. And so that means that the ECB portfolio, which is overweighing these dirty sectors, is not market neutral. from the point of view of this model. With the carbon tax, the purchases should address financial frictions, and that would mean to overweigh risky or dirty sectors, because you would basically have to reduce the financial frictions in these sectors the most. Without a carbon tax, what the ECB should be doing is overweight green sectors, because you want to lower their cost of capital. But in fact, the ECB does the opposite. So we can already say that we live in a world without a carbon tax. We see that the ECB is overweighing brown sectors. In the model, without a carbon tax, you should be overweighing green sectors. This is not what they do. And so perhaps if we lived in a world without climate externalities, then that's when ECB policy has a chance to be optimal, because it's overweighing these risky sectors. And so that is optimal if you don't care at all about climate externalities. So if these don't exist, then the ECB is doing a great job. Thank you very much.
No, great. Thank you very much. Both of you kind of exactly on time and both very interesting. So now we will open up the floor to Q&A. So we'll have about 9 minutes before we'll go to the informal breakout room. So if there is anyone here who has a question that they would like to ask, feel free to raise your hand now and we can call on you. Also, if there are any of the panelists who are here who have questions, feel free, you can just unmute yourself directly to jump in. So Frank Portier has the first question. Feel free to unmute yourself and ask away.
Thanks, Kurt. Can you hear me?
Yep.
Okay. Yes. Okay. Hi, everyone. That was a very nice talk. So the kind of purchase program, Monika, you're looking at is a kind of like structural, let's say, on average purchase program. It's not like a cyclical purchase program that would address another issue, which is like a temporary dire needs of intervention in some particular sectors. So then, how would you address the question in that case? Meaning that, then there's another trade-off, which is that, I have to balance some kind of like short-run benefits, or maybe, going to brown sectors, against like some kind of like future cost of making, the global warming problem more accurate.
Yeah. So, hi Frank. Thanks. This is interesting. So, I think so in this model, we took this kind of approach that's more long-term, but in principle, one could think about also a shorter-term version with fluctuations in these costs, right? I mean, these cost functions here are sort of a catch-all for health of the financial system, and then that could affect temporarily certain types of firms. And so what we learned here by thinking about this with this multi-sector structure is that actually, usually we write these models of intermediary pricing and QE with macro models where all these effects are aggregate. But in fact, even forgetting about the climate, just thinking about the sectoral implications is something that we should think more about, because you'll always get these effects like, so even if you just don't target anything, when there's safe debt coming in, it has effects that are different across sectors. And so I think there's responses by sector that are going to be different, even if we just think about responding to the Great Recession. So I think that's something where there's more empirical work needed to figure out sectoral impacts of these different of these policies that should depend on the relative degree of frictions. And that could then be evaluated using a model that has an explicit sectoral cost structure like ours.
Thanks.
Okay, Morton had a question, but definitely those of you that are still out there in the audience, don't be shy. Feel free to raise your hand.
Yeah, I was thinking, so, I mean, in the data, the capital structure of firms across these sectors appear to be very different. Is that, of course, that's not really the case in your model. So if you were to think about that, do you have any intuition about where that would take you?
Okay, so it's a good point. So here, so we have chosen to put all of the friction at the level of the intermediary, and in fact, the firms are completely frictionless, right? And everything is at the level of the intermediary, where then you get the sector. We think that is a convenient way to capture sectoral differences in funding costs that can be directly linked to the way we can measure how these costs show up in premia. Now, it does sort of fold into this object holding costs a whole lot of different things that are going on in the relationship between the intermediary and the borrowing firm. For example, capital structure decision of the firm, how easy is it for the firm to issue equity, what is exactly the marginal source of funding, etc. That's all in this model built into this, holding cost function of the intermediary. So then I guess what we take away is that so at that level that we've written it down, one can empirically investigate how the purchase programs matter for positions and premia by sector. And then there's sort of the underlying capital structure of the firm part that would also be, I mean, ideally great to make explicit, but I mean, the way we think about that is that sort of there's detail there. And various ways of doing that would lead to similar effects. So you know, for example, if you had firms that for whom it is hard to issue equity and the marginal external finance is debt, then you could directly look at the effects on bond prices in order to figure out what is the effect on the cost of capital. If instead the firm can easily issue equity, then you have to look at the effect on stock prices and so forth. So that's something that could be sorted out. But in principle, at the end of the day,
in principle, to follow what you were saying, then ECB would have to buy corporate equity as well and claims to bank loans, I guess.
Yeah, right. So I mean, so it's possible that, and one could investigate this further, is whether in order to achieve a holding something that's close to the market portfolio, to say that were desirable, one would have to use equity. And I mean, some central banks have started purchasing equity, so that's something that can be. But yeah, we get to look at that further.
The Swiss central bank, for example, buys equity, and so the question is that not a smart strategy in a world in which the economy has to transition to a more carbon-friendly economy? And so we need a lot of innovation by green companies. And so the question is, how do they get funding? And so they will be primarily equity financed. They will not be able to issue bonds. They're not mature enough to issue bonds. And so then the question is, shouldn't the central bank not buy equity of these green firms? Exactly.
Yeah, I mean, kind of slightly related, but I guess different. When you have, to the extent that there's policies like not carbon taxes, they could be affecting the premia in different sectors. I mean, could the, you know, if you're worried that maybe the ECB thinks that it's a financial friction, but it's a side effect of like a climate policy. I mean, it seems like that you know, I mean, I guess again to relate to what we said there could be some concern about you wanting to have coordination between those two to make sure that you're not interpreting, you know, if you are only kind of relying on premia, that you're not somehow undoing, you know, some other kind of type of distortion which is affecting the premia of sectors kind of intended from a climate point of view, as opposed to what's really a financial friction. And I guess, I don't know. maybe it's not a question or a statement, but.
Yeah, there is a lot of room for research into how the financial frictions as they are reflected in premia relate to emissions, right? And so it seems like from the existing evidence that there is a connection there. If there is, then this will really matter. But then, so it would be sort of cool to figure out exactly where it comes from.
Mm-hmm. Okay, any final question from the audience, if there's anyone there? Okay, well, thank you to both of our speakers and also to Martin, the co-author. For those that would like to continue the discussion in a more informal setting, actually that was just the panelists, I've just put the link to the other Zoom room there. So I will keep this room open for a couple more minutes because once I clicked end, you will lose that link. So for those, again, that would like to continue chatting a bit, we will see you over in that other Zoom room. Otherwise, thanks a lot, everyone, for coming, and we will see you next week, even though it is a holiday, I guess, for many in Europe, Ascension Day, we will still have.
Is that the right link, or is it the link to the same seminar? You just, because at Stockholm, did you do the after party? Because if I click on it, I come back to this one.
Okay.
So
sorry,
just,
we are.
So we just don't lose everyone there. So I'm just not sure if that is the correct one.
Hold on, Laura is creating a new link as we speak. So, or someone is creating a new link as we speak. Sorry about that. Didn't mean to keep you in an infinite loop. Or if